I'm done trying to convince financial advisors you need to learn this. If you want to learn it, I'll teach it to you. If you don't, that's fine. I don't have time to argue anymore.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Adam, thank you so much for joining me today. Super excited to chat with you. All right, Adam, you're the co-founder of Interaxis and a co-founder and chief compliance officer at Enclave Digital Wealth. Interaxis provides education on digital assets to financial professionals such as financial advisors, CPAs, and more. Enclave Digital Wealth is an SEC-registered investment advisor focused on helping crypto natives manage their digital wealth. Previously, you spent roughly 10 years as a financial advisor and planner. All right, Adam, before we jump in, do you want to give your quick disclaimer? I know you're registered and you're chief compliance, so what would tell us your cool disclaimer?
One of those things that we have to do now that we're SEC registered. But I just have to say, everything I share in this episode is for informational and educational purposes only. It is not financial advice, not an offer to buy or sell any security, token, or investment. Investing in digital assets involves risk, including potential for loss. Registration with the SEC does not imply a certain level of skill or training, and you can find all of our disclosures at enclavegroup.io/legal. Now we've done that deed.
Now we've done that. Now we can talk about everything fun.
Yeah, we can talk about whatever we want.
All right. So you spent the past like 5 years plus potentially, I think it's actually more than 5 years now, doing what I would almost consider like the thankless job of trying to educate tons of people in traditional finance about crypto. And you've been grinding nonstop. So I guess I want to hear about that experience because the grit and determination that takes is incredible.
Yeah, well, we started it, as you mentioned, Andrew. I was a financial advisor for over 10 years before that, had my own RIA, went down this crypto rabbit hole in 17 or 18 or something, when a lot of people got bit. And I feel like I realized and saw what the potential could be above and beyond just kind of trading crypto assets. I felt like blockchain technology gave us so many more potential benefits, and I saw it as kind of analogous to what I saw with the internet. Early days of the internet, which is when I was in college. So I kind of saw what trajectory it would be on, and I wanted to learn more about it. And then it occurred to us, around 2019 or so, we started a YouTube channel just to explain it. And I said, you know what? People are going to start investing in crypto if their financial advisor understands it. Who better to explain it to financial advisors than some people who have been in that business for a while? So sold our RIA at the time and started Interaxis. And the idea was teach financial advisors, financial professionals about crypto, about Bitcoin first, about Ethereum, decentralized finance and such, from the perspective of, yes, your clients want it. Here's how you make it a part of your practice. That's the important thing. Here's how you make it a part of your practice. Here's just not, hey, it's up, 100 million%. So you should have your clients in Bitcoin. But there are other aspects of it when you're a financial advisor, when you're fiduciary. But I wanted to teach that. I wanted to teach the technology because I think the ideas that it's going to give us, the theories and the theses and the actual practice of self-custody and of transparency and instant settlement and stable coins and all that is going to be game changing. It's going to change the way financial advisors do business, and better to learn how the tech works early. Much like if you learned how the internet worked early on, you were probably better set up to take advantage of it later versus just kind of coming along 10 years later and going, well, if I have to be on the internet, I will. But if you were one of the early ones, then you understood it, then you could kind of, plan your life, plan your career around it. So the idea was, I want to teach financial advisors not only how Bitcoin works and how ETH works, but how to understand DeFi and wallets and custody and make it a part of their practice and get them thinking about what those next steps would be.
So how are those early conversations in 2019? Were folks, were these financial professionals, were they totally oh my gosh, this is so out there, I don't even know about this? Or were they quite aware of Bitcoin, ETH, et cetera? Or what was it like in 2019, 2020?
2019, 2020, there was definitely awareness of Bitcoin and ETH. It was very much a, this is a Ponzi, or what you're trying to get is what the greater fool theory, someone's got to pay more than you paid for it. And of course, there was, a lot of talking from government, from regulators and such about how it's, laundering money, about how it's used for criminals. There was a lot of talk of that in the media. Even, so many financial services firms or financial professionals or financial titans were against it, right? Jamie Dimon, who's still pretty much against it, but Larry Fink at the time was still very anti-crypto. I mean, pretty much everyone was until mid-COVID, when Paul Tudor Jones finally said, look, I'm going to allocate some of my fund to Bitcoin because I think there's going to be inflation and this is what I'm going to use. That's when they really started to take note. But before that, it was very much the very skeptical financial advisors of, hey, we need to invest in something with real value, quote, real value to it. Where does the value of Bitcoin come from? Where does the value of ETH come from? And they saw it as just highly speculative. And of course, from a regulatory perspective, no one really knew. So in the eyes of financial advisors, it was, for most of them, it was like, well, why are we going to learn this? Why are we going to go down this road? We know it's risky. I don't want to get audited by the SEC. I have to give 10 times more disclosures to my clients. And by the way, it's not easy to hold Bitcoin. It's not easy to hold ETH when you're a financial advisor. So it was kind of yes, it's all a scam. Yes, it's all criminal money. I'm not going to learn about it anyway because I'm not going to put it in portfolios because I don't know what the regulators say. So it was, 99.9% of advisors were kind of going, whatever. Like, I know some of my clients probably have it and I don't care.
Were the advisors looking forward to talking to you? They'd be like, oh, I want to hear Adam out and hear kind of his take, even though I don't like crypto? Or were they very like, oh, this guy's coming around again. Like, oh, this guy keeps bugging me. I'll take the call.
Now, well, I'll tell you this. Early 2020 or early to mid 2020, it was those that were just really interested, right? And it was a lot of younger advisors that either they saw the potential, they had clients with it. These are advisors that wanted to get into crypto or DeFi. By late 2020, if you remember, that's when Bitcoin really kind of took off and it got up near 20,000 again for the first time since, late 2017 or early 2018. It got back up to, near 20,000. That's when we were obviously, the government was printing money every week during COVID. And so that's when they really started to take note because it was front and center, right? Everyone was talking about Bitcoin. It was moving up. It had moved up to almost 20,000. And so starting at the end of 2020, there was a lot of interest from financial advisors because they had more clients asking them about it as it was moving up. And remember, again, this is a time when all of us were at home, right? We had nothing to do but hang around on our computers and either talk to each other or read things or look at social media or whatever. And Bitcoin was front and center. And so everyone wanted to be a part. So when we did, some webinars and we did an online, obviously online only kind of conference for financial advisors around crypto, it was very well attended. And that went through, mid 21 and everyone wanted to talk to us. Everyone wanted to learn about it and they wanted to learn how to make it a part of their portfolios because there were so many clients that were interested and the price was going up. And of course you want to be the one that tells your clients about the thing where the price goes up. Right now, no one really understood what was going on with Celsius and Voyager and all that. And so there were a lot of people that got hurt. But yeah, I mean, late 2020, all the way through kind of mid to end of 21, it was great. Advisors were all over it. They just wanted to learn more about it.
And then in 22, 23, did that, I expect that to taper off dramatically. It just fell off.
Oh yeah, it went off a cliff because you had Luna, which was a huge blow up, right? Terra Luna. And that's, what gave everyone who was arguing against it and arguing for that it's a scam or there's no real value. They were able to point to that and say, see, it was, people investing in this quote stable coin and something that was supposed to be worth $1 is worth nothing. Even though that guy had $10 billion worth of Bitcoin or something, it still went to nothing. And then that blew up Celsius and Voyager and obviously later there was FTX. And so that's where people kind of said, look, this is still, heavily controlled by very few people. We're not quite sure what the value is. It doesn't make sense. And of course that was previous administration where they were very much anti-crypto, all the way from, the Fed, Treasury, OCC, SEC, IRS, just everyone was anti-crypto. And so for financial advisors, again, look, financial advisors, RIAs, have 10,000 arrows in their quiver that they can pull on. And why are they going to take the time to learn one that has all these questions around it and all this regulatory gray area? It just didn't make sense for a very, very small allocation. And there are very few investors that at the time, there are very few potential clients that were heavy crypto, right? And most of those, as you well know, want to do their own thing, right? They want to custody their own assets. They don't want to deal with a financial advisor. If you've made your money going from $0 to $100 million and it's all in crypto, you're kind of thinking, well, why am I going to talk to an advisor about this? They're going to make me sell it all. They're going to make me go into like an S&P fund or something. And I don't want to do that. So I might as well just not talk to them. So yes, I mean, to say that interest tapered off is an understatement.
And would you say that in, the end of last year, so when the new administration was elected, was that kind of the opening of the floodgates, or was that still kind of, okay, we have a more administration that's more pro crypto, things are going to start to trickle in, or like how did that, was there a dramatic shift with the new administration?
Well, the dramatic shift started before that, because the shift started when ETFs got approved, or we thought they were going to get approved, right? So what was that, December of 23, because the ETFs were approved January 24, right? So December of 23, that's when, it's probably even a little bit earlier than that, because you started to have, when BlackRock and Fidelity filed for an ETF, when Larry Fink started talking about Bitcoin and tokenization, when the SEC lost a few cases, right? Or I don't know, we can call it a jump ball or something, but for the most part, they were very positive. When they kind of lost or pseudo lost XRP or Ripple, when there were some judgments against them with, kind of against them in various other lawsuits they had going, and everyone kind of saw the writing on the wall. Okay, this is going to be a thing. Like, crypto is going to stay. It's not going to be completely illegal. It's not going to be completely regulated out of existence. The courts are kind of backing it up there. That's kind of when you started to see advisors go, okay, well, now that the courts are ruling this way, now that it looks like the Gary Gensler SEC might have to capitulate a little bit, because when BlackRock and Fidelity throw their hat in the ring, that they're not doing it for FOMO. Like, they know something. And that's when it really started to pick up. And then, of course, the ETFs came out and price went crazy. Oddly enough, Andrew, that's when the interest in advisors learning more, to the level that we give them, actually didn't go up. And I think part of the reason is because once there was an ETF, that was their easy button. They didn't need to know that much about Bitcoin. They didn't need to know that much about how it works. They could just tell their clients, look, allocate, 2%, 3%, whatever. You can do it in your IRA. You can do it with this ETF that's been approved by the SEC. They've kind of wrapped up custody and insurance and everything else. So we don't need to know that much about it. Right. And that was, it's kind of been a bummer, because I'm like, look, price is going crazy. And a lot of advisors still don't understand Bitcoin and ETH. They just know that they can allocate to it, to exposure to it via an ETF, but they still don't know very much about it.
Yeah. So how do you expect that to evolve over time? Will the folks that have wealth managers, will their traditional wealth manager just allocate to ETFs and call it a day? Or do you expect there to be some sort of, specialist like yourself that they partner with, these wealth managers partner with, to be like, hey, my clients want more than just ETF, like, can you help them? Or how do you expect things to evolve?
I think it's going to go a few ways. One is, look, the ETFs are around to stay. They're super easy. They're very easy to fit into retirement accounts. Remember, there's like $17 trillion in retirement accounts in this country, right? So if you can allocate 2% to Bitcoin and ETH spot ETFs, that's a significant amount of money, right? So that solves a big problem in terms of allocation. What I think and what I hope happens is, as we start talking about more on-chain assets, right? Whether that's on-chain funds that, like the likes of BlackRock and Franklin Templeton are launching, whether we talk about the, quote, real world assets. We've heard about, DTCC, of course, acquired Securency, and so they're going to tokenize more issuances. I think as we see that, we're going to have more specialized advisors, kind of like us, that understand crypto custody, whether that's with qualified custody, whether that's with on-chain assets. And we'll obviously go into that a little bit later, but I think there's going to be more specialized like us. I think advisors are going to realize more of their clients have significant amounts of crypto than they knew, and they're going to have to give them some advice. And that advice isn't going to be able to be just put in an ETF. If you have a client that shows up and they've got 6 figures of Bitcoin sitting in a Coinbase account, then you can't just go, oh, well, let's just sell this and go to the ETF. These are people who, that's not what they wanted, or they would have already done that. Right. So I think advisors are going to find that more of their clients hold more crypto assets, whether with a custodian or on chain than they think. And that's going to just become more apparent, I think, as it becomes okay to tell your financial advisor about it.
From an advisor perspective, do you think that the opportunity today is more so with the crypto native clients versus the clients that are with traditional private wealth managers that want access to crypto, but they're like, listen, I'm happy with my ETF and with that my advisor recommended me?
I think they're two different markets, right? Like, I think there's a significant amount of crypto wealth that needs help being managed, which of course is why we started our RIA. I think there's a significant amount of kind of traditional wealth that wants access and exposure to crypto. Again, whether that is in the form of owning Bitcoin and owning ETH and Solana and other tokens like that, or in the form of, I want to find out what these tokenized funds are like. I want to find out what tokenized real estate is like, because I like the idea of better liquidity, or I like the idea of more transparency. I think it's going to like kind of come from both sides, and you're going to have some sort of meeting in the middle of financial advisors. Overall, the financial system and the financial network is going to have to encompass more on-chain assets. It's going to have to encompass more combination of qualified custody and self-custody, or qualified custody and multi-party or multi-party computation wallets, or multi-sig wallets, or something like that. I think we're going to see more of that because, as you very well know, if you go on chain, you have access to more yield opportunities, right? Like, you just have access to have greater income opportunities. You have access to greater diversification in a kind of an easier fashion than you do trying to piece it all together with traditional custodians.
What have you experienced the traditional wealth managers tell their clients today in terms of like, hey guys, we don't recommend crypto because I don't, obviously I'm very crypto, so I'm not aware of the current things that they say, but like, I feel like we've gotten a lot of the main issues out. It's like regulatory uncertainty. Now we have a pro crypto administration. There's security issues. Okay, now we have qualified custodians, so on and so forth. It's like, what are the main excuses, we can call it, that traditional wealth managers are telling their clients? Like, hey, don't do crypto. There's volatility, but what else?
Right. I think there's a volatility. I think most advisors still don't understand where the value comes from. I think it's more of, my clients are interested in it, so now I can use the ETF and for lack of better terms, just shut them up. Right here. Here's your allocation to Bitcoin or to ETH. We'll do it through the ETF. And I don't quite understand the value. I don't quite understand why it should go up. But if you want it, let's get it. Right. I still think there's a lot of that going on. I still think there's a lack of understanding. And honestly, it's hard to get, man. It's hard to understand the value of Bitcoin. It's not something that we're native to. It's not something that a lot of us grew up with. It doesn't make so much sense. It's not something you can see or feel or touch. And yet we kind of equate it to gold, which we can all see and feel and touch. And we know it's coming out of the ground, and we know we wear it and all those things. So I think there are still those, plenty of advisors who, I don't even want to say they're all older advisors. I think there are just plenty of advisors who either, completely don't understand, or I don't want to say completely don't completely understand the value propositions, don't completely understand how it works. And plenty of them that go, look, the system works just fine. Like we're the greatest economy the world has ever seen. We have hundreds of trillions of dollars being managed by financial advisors. We have all these other asset classes that we can go into that we understand. Why do we need this? Like, there's not a reason to move things on chain. There's not a reason for tokenization. So it's very much like, what problem are we solving with this? And that, I think, is the main. I talked myself in a circle, and I apologize for that. But it comes all the way back to, what problem are we solving? Or are we creating problems to solve, or creating solutions without a problem? To a lot of them, I answer, what problems did the internet solve? We were the greatest economy ever before the internet came. And there was no one going, man, I really need to buy a book and have it delivered to my house later today. And it could be any book anywhere in the world. And I'm going to order it on this weird internet. Like, there was no one saying that. There was no one saying, man, I wish I could post my inane thoughts and everyone who follows me gets to see what thoughts I have as long as they fit under 280 characters. No one was saying that. And yet Twitter seems to be pretty important, right? So the technology moves forward regardless of whether you think there's a need for it or not. If we have access to better technology, we're going to use it. But still, I think there are a lot of advisors who say, we're not really solving a problem because the problem doesn't really exist. We're just fine without it. And like, I kind of agree. Like, you and I, being kind of crypto native, can come up with a lot of problems of the financial system. But overall, most people go about their day pretty well in the US, using banks and using dollars and using debit cards and using credit cards and Apple Pay and Google Pay and everything else. They do it just fine. Right. So it's not like it doesn't seem like you're solving a ton of problems, but you're moving the technology forward.
I think someone I spoke with was saying that in order to really understand Bitcoin and then understand ETH and Solana and kind of so on and so forth, it requires, I think it was like 30 hours of self-study, or, some large number of hours of people being dedicated to really dig in, to really understand, okay, why is Bitcoin valuable? Well, why is it interesting? And then that's kind of stage one. Stage two is kind of the smart contract platforms. It's okay, Ethereum, why is that important? So on and so forth. So I guess I am, after spending so many years talking to folks about, why crypto is so cool and why you should get excited about it, I personally less bullish on convincing those that don't really like it at this stage. It's like either you like it or you don't, almost at this stage. I'm sure we convert a few more people a few million more people every year, but I kind of feel like, or the question is, where is the demand from clients going to come from? Or is it going to come from these high net worth individuals being like, hey, Mr. Advisor, I want crypto, like, get me crypto? Or do you think that these more and more advisors will say, hey, you know what, this is a big business opportunity for me. I should get educated on crypto. I need to dig in here. Or you feel like they're just too comfortable?
I think there's going to be more and more demand, one, from high net worth individuals that either want to be involved in crypto, meaning owning crypto assets, or again, being on chain, whereas, having different, diversification in terms of yield. You're going to see more and more, I think, businesses that are going to want to either transact on chain, stable coins and such. We're seeing more and more of that because they're global businesses, because it makes sense. Or you're going to see more businesses we've already seen that want to hold Bitcoin on their balance sheet, right? Go either the full-on sailor route, or just go, look, we have some cash, we might as well hold it in Bitcoin, right? Instead of just holding it in cash at the bank. So I think we're going to see more and more demand that way. And you're right. Like, I'm done trying to convince financial advisors you need to learn this. If you want to learn it, I'll teach it to you. If you don't, that's fine. I don't have time to argue anymore. And it doesn't make sense. It's a waste of both of our times. We're not going to change our minds, right? So when you said it takes 30 hours of study, it takes 30 hours of open-minded study, right? If you go in with a closed mind, very few people come out of it going, I totally didn't think Bitcoin had value, but I studied for 30 hours and now I'm a total maxi, or I'm a bull or something, right? Because if you go in skeptical, you're likely going to come out skeptical. So I think it's just going to be a slow demand. And that's honestly, Andrew, kind of what I tell some of the crypto folks that go, look, we want to get in with RIAs. We want to get in with financial advisors. And the line they use is, Bitcoin is the best performing asset class of the last 10 years. It's up 100 million% or whatever it is. And my answer is like, that's your clients don't care that it is the best performing up till now because they weren't in it up till now. What's it going to do from here going forward? That's the important part. And so I think as more people kind of understand it, and honestly, as the economies change, right? As the global economies change, as we have more money printing and more inflation and more commerce that is happening internationally, right? We've had commerce happening internationally since the internet grew. but we haven't had money work that way. And so I think as more and more international businesses start to go, okay, we're going to transact using stablecoins, we're going to transact on chain, I think it's naturally going to move down to more people are going to have assets on chain, and therefore their advisors are going to have to know what to do with it. That's on one side of it. The other side is the likes of, again, I'll go back to BlackRock, Fidelity, but mainly BlackRock, because they're doing a lot of pushing, right? When BlackRock starts tokenizing funds, and you know that they're going to do a lot more than the Biddle fund, right? Like the Biddle was their easy onboarding because they could hold treasuries underneath it, which have no risk, right? Versus the having more risky assets. But we're going to see BlackRock probably tokenize more of their funds, right? And if BlackRock, with their multi-trillions of dollars that they manage, kind of forces it down on all these advisors and says, look, we're going to issue these on chain, and you can either buy the regular version, which you can trade, regular market hours, or you can get the on-chain version, which trades all the time, which you can use as collateral in these various DeFi ecosystems. Which are you going to go with? And a lot of advisors are going to go, you know what? We have more flexibility with the on-chain version. We're going to do that. So when the biggest asset manager in the world starts kind of pushing it on people, they're going to have to learn. The advisors are going to have to learn. Otherwise, they're going to be kind of cut out of the biggest benefits of BlackRock deciding to do that. And BlackRock isn't doing this as FOMO. They're doing it because if they can save 5% in their overall expenses, that's a multi-billion-dollar number, right? So if they're going to do it just to save money, that means I, as a financial advisor, am going to have to learn it because BlackRock wants to save money.
So at what stage did you decide, okay, I've been educating these professionals for so long, I want to now, launch my own or co-found my own, digital wealth platform with Enclave?
The Enclave came about because one of my partners starting Enclave, Clayton Cruz, is a tax and estate attorney. Been working with crypto native clients for years, which not a whole lot of them work with crypto native clients. It's not an easy thing to deal with, but Clayton's been doing this for years, and he basically called me and said, look, I need to start an RIA, or I want to start an RIA because we have all these clients and I can't help them manage their money. I can't manage their wealth. I can't put them into qualified custody because I don't have a registered entity. And I said, well, I have my licenses, so let's go do that, because we have, enough potential clients that already have their wealth on chain. And as we went through it, we brought another partner, Jason, who is his expertise. He comes from a background of Fidelity and hedge funds and such, but his expertise the last several years has been kind of DeFi and on-chain market making, and said, look, we have all these projects that are launching tokens. And what happens is the founders especially get very wealthy overnight. The protocol has this TGE event. The protocol then usually has a DAO or something where they have this huge treasury of their own tokens. They need help in managing their wealth, just like anybody else who's wealthy, right? So start with those founders. Those founders now have a tremendous amount of wealth, but it's all concentrated in their own token. It usually has a vesting schedule, an unlock schedule. So how can we help them, one, with asset protection? Privacy has obviously been a huge one for those in the crypto circles that probably follow what happens around the world in terms of, kidnappings, abductions, and all that around crypto. So asset protection, privacy, are you setting up the right structures to receive your tokens? So it's not just going to your personal wallet. Are you staying private? Are you being tax efficient? And then once that happens, like, okay, now you're a wealthy person. Congratulations. You need to be able to spend your money, and you can't spend it if it's all in your own native token. So how do we get you into stable coins? How do we get you yield? We can keep you on chain, but we can also help you live your life. And we can help you do it in a way that's tax efficient and private and protect all your stuff. Again, just like any other wealthy person would, just like any other tech founder would. They would hire an advisor, they would hire a team, and they would protect their stuff. It hasn't been done as much in crypto because the thought is the professionals don't understand wallets and custody and on-chain yield and everything as much as we do as the founders and the degens and such. And what we're saying is, we've been talking about it for years. We understand it. We understand the legalities, the regulation. We understand how to protect it. We know the custodians. We know how to work with them. And if no one else is going to do it, again, I've been teaching it for 5 years. And if no one else is going to start the RIA like this, we will.
You know, it's funny because hearing you say it, I'm like, well, of course, like that should exist. I'm surprised that from my knowledge, you are one of, if not the only group of folks that are targeting these crypto natives with, I don't know, estate planning and taxes and kind of the full gamut. And yeah, a lot of these crypto natives are very wealthy and have a lot of their wealth on chain, don't necessarily want to go off chain for everything. And so having a specialized group like yourselves makes total sense to me.
And there's also little things, Andrew, like they have a tough time setting up a regular bank account, right? And so if we can help with that, if we can help the onboarding to the regular bank account, we can do all the KYC that needs to be done to help out all these different custodians so that they, we're taking some of that off their plate, right? And we can help, again, just be good financial advisors so that these founders can go build their protocol. I mean, they're just entrepreneurs, right? They want to spend their time building what they're supposed to be building, creating and trying to build up their protocol like a company. And if we can help them so that they can actually have a life, so they can live their life and not worry so much about their money, so they don't have to spend time looking at TradingView or thinking about their wallets or thinking about their airdrops and everything, then they can go build what they need to build. And when it comes to managing like a treasury, a protocol treasury, then again, like you have a shot, especially when you do a TGE or some point, to get some cash in the door that can sustain you for several years, so that if technology changes, if there's new protocols launched, whatever it might be, you can pivot because you had that token generation event and you went into some stable coins potentially, and now you have a 2-year runway and you say, okay, if we have to pivot, at least we have the money to do so and we're not wholly reliant on the value of our token. Right. So if we can help manage that as a business, like any business would manage their treasury, we want to help that because we feel like it stabilizes the industry a little bit. It helps stabilize. So you don't have a protocol that goes up to $2 billion in value and then down to zero. And you go, man, like if they just would have kept some of that money with the talent they have, they could have pivoted their protocol. But because they were trying to, YOLO their own token and think that that's what was going to drive them, they end up kind of going out of existence.
It's also kind of like damn if you do, damn if you don't, in the sense of when people, not always, but when folks see, oh my gosh, these founders are selling, 20% of their tokens into stables, or like they're not believers, or they're putting into Bitcoin, like they're not believers. So you do see some of that online, but honestly, it's like if you're going to be fully in your token, that is also extremely risky just from a business standpoint. So.
And part of what we do is we help them with that. I mean, not necessarily obscure it, but we help go, okay, this is going to be their plan going forward. So when they go to sell, it's not like everyone freaking out going, oh my gosh, the founders are selling. It's the founders are always going to sell a little bit. They're always going to, get some liquidity out of what they have because they want to live their life, because you can't live your life on your protocol token, right? Like you can't buy a house and a car and you can't travel and all that. Like you just can't do all that yet. And so they want to be able to diversify too, just like anyone who starts a tech company diversifies out of their stock at some point. And it's not because they don't believe in their company. It's because that's what you do when you get wealthy. You diversify and you don't have it all in one basket.
How do you think about customer acquisition? Because obviously Clayton, you mentioned, is like a tax and estate attorney. So the great group of clients I would expect from that standpoint. But are you guys just reaching out to folks directly, or, how are you thinking about acquiring new customers?
Right now, it's very much a lot of word of mouth, right? We've been doing this a while. It's, like I've been, of our group, I've been the most public. And so it's going back to the network of people we have like you and saying, here's what we have now. Either, for you or people who does this make sense for, right? And so we have a pretty big network of folks we can talk to that either need these services or know people that need the services, right? And some of that network is VCs that need it, and their portfolio companies also could use the help. It's talking to some of the technology partners that we have that know who's going to be launching a token soon. It's talking to the CPA partners that we know, because what I always say is if there's any financial professional that knows what someone has in crypto, it's their CPA, because they got to pay their taxes, right? So it's the CPAs helping us out. So right now it's honestly very much word of mouth. We don't plan to do a whole lot of marketing or anything like that, other than do podcasts like this and some posts and webinars and such. But for the most part, it's going through our network. And it'll take us a while to get through everyone we have in the network and those that want to be onboarded and those that want the help. It'll take us a while to get through all that. And in the meantime, we're happy to talk to anybody else. We're happy to work with anyone else that comes through. Again, I was just at a conference last week. We were at Consensus. We'll be at Permissionless. We'll be at Bitcoin. So we'll be all over the place talking to people, but it's going to be very much either face-to-face, word of mouth, someone who knows us. Because one, there's plenty of them. Two, this just takes longer. This is not traditional like Fidelity, Schwab custody where we just go, all right, here's all your paperwork. Once you fill this out, you're onboarded and you have 7 different accounts. This takes a lot, right? It takes a lot of structuring, Clayton working with people on their LLCs and their trusts and making sure those are structured appropriately. It takes a lot of onboarding and KYC. And then honestly, these are busy people too, right? Like they're doing other stuff. As you know, it's 24/7, 365. They're all over we have clients that are all over the world. And so trying to work with all of them, it's just taking a lot of our time. So again, in terms of customer acquisition, a lot of it is just right now, network, word of mouth, face-to-face, until such time as we have such great processes or so many advisors on with us that we can onboard a lot faster.
Yeah. What are the most requested services from these clients? Or is it mostly, hey, we want help with yield diversification, which I assume if they're crypto natives, probably not. Or is it more like taxes and estate? Or is it like, banking? Like what are the most requested services?
Some of the first ones is, especially if it's founders that are going to launch a token or have launched a token, it's taxes, right? They talk about capital gains tax and such, and how can I mitigate some of that? Then once we start talking to them, asset protection becomes a big one when they realize like just because your assets are on a self-custodied wallet doesn't mean they're not your assets. If you get sued, whether it's a business reason or whether it's because you wrecked your car and it's your fault and you hurt someone, all your assets are up for grabs unless you've protected them. And you can't, go before a judge and be like, well, it's on a wallet and you're not getting my private key, right? Because the judge will be like, all right, well, you're going to jail then. So there's like, once they kind of talk to us and realize that, then asset protection becomes kind of a big one. So asset protection, tax efficiency, privacy has been a big one. You believe it or not, yield generation is actually a big one because a lot of the folks we're talking to are not kind of the typical degens. It's not people that are just trading all the time. It's more people who have accumulated a great deal of wealth in crypto, whether it's because they've held Bitcoin or ETH or Solana or some other tokens for a while. And they're not, degenning into all these different liquidity pools or anything. They want help generating yield. They want it to be safe, relatively risk-free. They don't want to be having to, hop in and out of different wallets all the time. They want someone to help them with that. So that, again, they can go do what they need to do. So yield gen has been a huge one for us. That's a hugely requested service. Because the way we want to do it is not necessarily going and finding, the 180% yield. We want to find the, upper single digit, low double digit that's in stable coins and incredibly safe and not volatile, because that can stabilize the rest of their portfolio. So believe it or not, like we're getting to that point in the cycles, I think, where those that have built up a tremendous amount of wealth realize I can actually get help from someone and not do it in a way where I'm totally giving up all my crypto.
Do you expect that over time, traditional private wealth managers and financial advisors will want to partner with you guys as like a sub-advisory, like through a sub-advisory?
I think they will. I mean, we've talked to some of those. We've talked to some that represent family offices and such that want some allocation here. So yeah, we're already in talks with some kind of larger private wealth managers about how they can partner with us for us to handle some of that, whether it is their clients that just want to own crypto, they just want to own Bitcoin or ETH or something, and they're just going, look, you guys have done all the due diligence and research, and now that you're regulated, we can outsource this to you. Or it's outsourcing to us because we have different yield strategies that still remain safe, and we still make sure there's insurance, and we still have processes to keep them all within qualified custody as long as possible. Yes, we're already having some of those conversations, and they're kind of growing by the day. So the time we spent at Consensus last week actually added to the possible partnerships we might have with other wealth managers. And it's very common in the wealth management space, right? Like if you're a traditional wealth manager and, I get you as a client, Andrew, and we go to Schwab or something, well, I'm going to pick other portfolio managers that are on the Schwab platform to put your assets into. And those are RIAs as well. So this is something that is very typical in the wealth management world, is you outsource to someone who's an expert at doing what they do. And everyone kind of gets their little fee along the way. It's the job of the traditional advisor to go, all right, we're going to allocate, 10% of your total portfolio to on-chain yield generation, and we're going to give that 10% to Enclave, who's going to manage it.
Very interesting. Okay, so could you walk me through, you kind of there's two different client archetypes. You have the crypto natives who basically need like the full traditional stack because they're coming in with like very little. It's like, hey, I need help with tax and estate and protection and everything. Then you have these more, traditional high net worth people that want crypto exposure in a more safe and controlled fashion. And I guess, what are the different? Can you walk me through the different client experiences? Just take me through the crypto native, and take me through the more traditional high net worth.
Sure. So the crypto native, the stories are a little bit different, right? It's about maybe they've been through the cycles already of up and down. Maybe they've already lost a tremendous amount of wealth, and so now they talk to us. And again, we start with things like tax efficiency, right? I'm going to have a huge capital gain, and I can either move to Puerto Rico, or if you guys have some other way to address this, we'll address it. I'm going to have a capital gain on my tokens that I'm going to get gifted to me, or is going to be part of our token generation event. So we talk a lot about tax efficiency, and it's of course educating those crypto natives on what happens in what wealth management is and what asset protection is. And obviously stereotypically, most of them are relatively young. And so the conversations there are really around what traditional wealth management is like and what they should be doing and what wealthy people do for the most part, which asset protection is asset protection, whether you're on chain or you made your money in banking or manufacturing or something, right? You protect your stuff. It's just that the traditional wealth kind of knows how to protect their stuff. Like they've been through this before, and it's a little simpler. So with the crypto native, it's explaining, we're not taking your money. We're not going to make this harder for you. We are going to keep you private. We're going to keep your assets safe as much as we can. Yes, you're going to have to pay fees for this. You're going to have to pay fees to us. You're going to have to pay fees to custodians. Yes, at some point there is going to be qualified custody. So it's those explanations and getting them, I don't want to say out of the ethos of self-custody and out of the ethos of crypto, but understanding where we can bring the two together and still get them the goals that they want in their life and the goals from their wealth. So that's the crypto native part. Did I answer that effectively?
That was great. Yeah.
Acceptable. On the more traditional side, the education is, if we're just talking about owning crypto assets, it's what is this? How do we hold it? Why shouldn't we just own the ETF? Where does this fit in the overall scheme of our portfolio? And I've talked to a lot of financial advisors about this that manage those private wealth and address with them. How do you have those conversations with, high net worth individuals? And as I told you earlier, the conversation should not be, well, this is the best performing asset class ever or something. The conversation should be, if it's Bitcoin, are you allocating something to hedge against inflation? Do you need to allocate to hedge against inflation based on your business or based on how you make your money or based on where your wealth is? And then does Bitcoin fit in that in terms of Bitcoin, gold, real estate, commodities, whatever you want it to be? And then how do we hold the Bitcoin? If it's something like ETH, okay, do you want an allocation in your portfolio to tech growth? You might have it through, various ETFs, various, NASDAQ ETFs or something, or tech ETFs. But do you want to look at something that might be the next Amazon? Right. And that's where you get into, do you want to own ETH or do you want to own Solana? And then some of them, have heard about generating yield on chain, and it can be, you can generate more yield if you go on chain, and we have to have conversations about why it's safe and secure and what we do to keep it safe. And then have an honest conversation of, is it worth the risk? Is it worth the risk of you taking, a few $1,000,000 out of traditional custody, out of traditional assets, and, moving them on chain, buying stable coins, managing that? Is it going to be worth the fees you pay? And some of them say, no, it's, what, at this point, it's not worth it, because, if you're making me 10% and then you're taking 1 or 2%, you and the custodian, everyone else, look, I'd rather get a little bit lower yield and take almost no risk in treasuries or something, or in corporate bonds, which I know very well. Right. So it's kind of a different animal, going to the traditional side. There are a few family offices that are doing it. There are a few wealth managers that really want to get into kind of the on-chain yield space. And for high net worth or ultra high net worth, it's dipping their toe in a little bit. I'll give you a couple %. We'll see how that works. We'll see if we can keep it safe. We'll see if we can earn the yield. So I think those are kind of the 2 points, right? The traditional, it's, why does this make sense above and beyond just, I'm hoping Bitcoin goes from wherever it is today, 100,000 to 1,000,000, right? And that would be cool to have, a few % of my portfolio in there. But above and beyond that, it's, why does this fit and where, and what's our plan? And that's what we talk to the more traditional investors about.
How is the infrastructure for the kind of the crypto native activities? We're talking like QC, we're talking, the yield, the wallets. We're talking, you mentioned on like Schwab, for example, they're the different managers that specialize in their different functions or strategies, and you can allocate easily there. So like, obviously estate planning and taxes, et cetera, that's all taken care of. That's all known. But in terms of doing these crypto native functions, how is that infrastructure today?
It is definitely not as buttoned up and sewn up, right? You have multiple custodians. There's, you have like Anchorage, for instance, which is the only OCC chartered crypto bank, right? Federally chartered. You have various other custodians like BitGo and Kraken and Crypto.com that are registered in different states, or they're trust companies or something. So, but they all don't play that well together. Right? There's not one custodian that kind of wraps it all up like a Schwab or Fidelity does in the traditional world. And obviously, going on chain, obviously, if you go to qualified custody, it's not very easy to interact on chain. You got to get into, certain wallets. So it's really us having to put together what that all looks like to remain somewhat compliant. I say somewhat, remain as compliant as we can, reading the rules as they are right now, knowing full well there isn't guidance from the SEC that says, here's exactly how you do it when you're managing crypto assets. But trying as much as we can to be compliant according to the regulations as they exist now, and putting together all the tech pieces and making sure as assets are moving from one piece to another, that they're remaining safe and secure as we can make them, figuring out where the risk vectors are, figuring out where they can be attacked, figuring out where things might, we might have issues with KYC or AML. And yeah, we're having to piece all that together and make it look kind of seamless. But in the background, we are, really working hard to make sure that we can go from qualified custody to wallets, and get people the yield and everything they want. So it's not just sitting there, holding assets. It's actually generating some income, and yeah, it is definitely not there. It's definitely not as buttoned up. You can't get it all under one roof, for sure. So we have to we have to manage, several custodians, several wallet vendors, several different yield strategies, and keep it all in a compliant wrapper.
These different strategies that you're allocating to, how do you expect that to? How is that playing out today, and how do you expect that to play out in the future? Do you think that we're going to have a Schwab-like platform where you just look at, oh, this person is doing a Solana, USDC strategy I want to allocate to, boom, and then so on and so forth, and it's all within a QC. I guess that's where it probably has to go. But I guess today, how does it look, and how do you expect it to evolve going forward?
I think it will evolve that way. I think there's going to be plenty of yield strategies, growth strategies, portfolio strategies that are developed. Some of those are going to be developed by people. Some of them are going to be AI that develops them, right? So that's going to be a new thing, is like, how do I vet an AI? program. But why would that not exist? Why? I mean, it's not that much different than a robo advisor, right? Like, which we've been dealing with in the traditional world for years, and they've done really well. So I think we are going to go to, I mean, what you're referencing is kind of what we call a TAMP, right? Turnkey Asset Management Program, which is, Turnkey Asset Management Platform, which basically says, here's everything you have available to you. You can do all your research on them. And then based on all, this $1 million you have in here, you can allocate 200,000 to this strategy and 300,000 to that strategy. The difference here is some of those strategies might be on chain. So it'll be interesting, Andrew, to see how we consolidate qualified custody with on-chain strategies and get that in some sort of qualified custody kind of wrapper. And part of that is seeing what the SEC comes out with in terms of guidance around custody and guidance around what that looks like, because obviously their custody rules now were written for traditional custody as we know it. And there aren't any rules written for self-custody or on-chain custody or MPC wallets or anything. There are no rules written for that. So it's a combination of, we have to do what we feel it fits within compliance as it stands now. And then we have to see what the SEC is going to come up with to hopefully help guide us. And we have to see what the technology partners are going to come up with. What is there going to be some sort of integration between Anchorage and on-chain wallets? Anchorage has an on-chain wallet called Porto. Is there going to be some integration with something like Fireblocks, right? Is that going to be qualified? It's going to be deemed qualified. How do we keep it safe and secure? How do we keep hacks away? How do we keep the big thing from the SEC for RIAs is, don't put yourself in a position where you can steal your client's money. Well, how do you do that and have discretion over client assets and be able to trade them in an on-chain world and not have the ability at some point to take the money, right? And we have to come up with all that. But yeah, there will be platforms that say, here are all the different strategies. Some of them are going to be on Base or Solana or Ethereum mainnet or Plume or whatever other networks are out there. And yeah, you're just going to get to allocate to them. And some of those are going to be RWA tokens that represent some sort of yield or represent assets like real estate where you can diversify more. And the beauty of it all is you're going to have so much more transparency, right? You're going to have solutions, you're going to have software that's going to be able to look across all of that and look at your portfolio and your life and go, here's, this strategy is riskier than you think because of everything else in your portfolio. It'll subject you to much more risk if ETH goes down in price or something, right? Like, we'll be able to do that relatively easily. But yeah, there's going to be a whole bunch of strategies out there that are going to go into, kind of a model or go into a platform, and you as the investor or with the help of your advisor, hopefully is going to get to choose whatever fits your life.
Yeah, it's also interesting, what's considered assets under management versus assets under advisements when you have like a qualified custodian versus like a custody, a self-custody wallet that the client is in control of. So I think that, hopefully we'll get some guidance on that over the coming years. It's a good positive though.
Yeah, it'll take a little while. Of course, it's government, and it'll take some time. And my worry is always the more guidance and regulation we get. All regulation, all legislation is a compromise. And so the question is, what are we going to have to compromise to be able to manage assets on chain, or to manage assets and get these yields? And remember, as more people use these, as more money goes into these yield strategies, the yields are naturally going to come down. Part of the yield that you're getting is because most people don't understand it. And because most people, there's a pool that's like USDC and whatever the USDC equivalent is in euros, right? And it's earning a tremendous amount of yield right now. And literally swapping $1 for €1, but doing it in stable coins, but that pool is earning a lot, right? Well, that's, as more people use it, of course, the yield is going to go down, right? So it's not like we can keep up these yields forever. Eventually it's just going to be finance, and it's not going to be where the yield is the business plan, right? The business plan is going to be 24/7, 365, different kind of custody, more transparency, more interaction, more opportunities to lend and borrow and participate in the system. For right now, the real selling point is more yield.
Give me the 10-year grand vision for Interaxis and Enclave.
Okay, the 10-year grand vision for Interaxis. I see our education kind of being integrated in, right? Like I could see it being integrated in with some of the big players, integrated with some of the big fund managers, whatever it might be. I think there's going to be a point where that's just going to be something advisors learn, and whether they learn it from us, where I'm integrating with some universities. So whether it's executive education for some of their alumni, or even we're integrating it in with the undergrad education, I think that's where it's going to come from. And people are just going to come out of college naturally knowing this now, right? Just like, I mean, people coming out of college now, native to internet, native to smartphones, it'd be silly to like teach them how the internet works. So eventually that kind of gets phased out a little bit, because everyone's just going to kind of know the basics, or it's going to be so ingrained that like they don't need to. The 10-year vision for Enclave is I see us, managing a lot of the wealth for, again, crypto founders, continuing to go down that route. I see us helping to facilitate, like you were talking about, those TAMP platforms, those platforms that say, here are all the different strategies. We're a regulated entity. If you have a fund, whether it's a hedge fund or something, and you've only been able to target accredited or qualified investors, and you can take that same strategy and go through us and distribute it, I think that's a big growth area for us. As Enclave, I think there are going to be a lot more partnerships with various private wealth managers that once you get some exposure on chain, I think there are going to be a lot more businesses that are going to utilize our services, whether those businesses are kind of traditional and know that they need to use stable coins and know that they need to manage some of their assets on chain and they can get better yield, but it's not like they're doing it because they want to buy Bitcoin. They just want to, manage, stables and yield, and they can do it through a registered entity. And I think there's just going to be so much more global wealth that is going to be okay, that is going to understand that, yes, we made our money in crypto, but we understand that we still need help. And I think we're going to go different directions, where some of it is us acting as kind of a multifamily office, and some of it is us acting as a sub manager for other financial advisors that just want to allocate a few percent and they can come in through us. We're going to have more probably advisors underneath that are kind of those sub allocators or sub managers. I see us having a tremendous number of financial advisors as part of our group. I mean, directly as part of our group, that are just going to go get clients. And a lot of those clients are going to be mostly on chain. Right. And eventually, like, it'll all merge. In 10 years, I don't think there'll be that much of a difference between on chain and off. I think it'll all be on chain, not because everyone wants to be crypto, but because it's just a better system. You'll have the DTCC integrated, and you'll have all the big banks and all the big custodians integrated on chain. And that's just going to be natural. And we're already going to be there. We're already going to have been managing it and helping to put everyone together, put all the technology together. And that'll all consolidate too, right? Custodians, wallets, like that'll all get relatively consolidated, because it's just going to take money. It's going to take lobbying. It's going to take, hands in the regulatory pies. So I didn't really give you a very good answer on where I think we're going. And the deal is, I don't really know. I can say, hey, I think we're going to be the Goldman Sachs of on-chain wealth management, but I think that's limiting, and it's not limiting on I think we can only be the size of Goldman, but I think it's limiting in saying there's going to be like a copy paste of the traditional world and we're just going to make it on chain. I think we are, I hope we are flexible enough to go, we're going to go with where this takes us under the understanding that what we're trying to do is help people keep their money safe, help them get it to next generations, help them do what they want with it, help them be entrepreneurs, and do it all within a wrapper that says we're going to maintain compliance. We're going to maintain compliance with the SEC and everyone else we have to be compliant with. We're going to maintain qualified custody as much as we can. We're going to see what we can do to keep everyone's money safe, but go wherever we need to go. And if that's more yield strategies, if that's creating a TAMP, if that is working mainly with private wealth managers and having them bring some of their assets, we're going to go where it needs to go, because our deal is, manage assets on chain as much as possible, but do it in a way that's compliant.
This is a question I want to ask you, because you have a professional, more traditional background in professional finance. How have your personal views evolved on crypto? Because, I came from like a very crypto native, I got in Bitcoin in 2013 and was very down with the Fed, down with the dollar, like very radical. And now I'm such a traitor to the original vision. I'm like, man, everything should be in a qualified custodian, and I'm, everything should be safe. And if there's a big hack, we should roll it back. Like I've gotten so far from my original kind of core crypto views, but how have your views evolved while being in this space? Because you came from traditional background into crypto.
Yeah, okay, that's a good question, because when I was in my traditional background, I mean, before I went down those rabbit holes, I was the same as most advisors. I'm like, this is crap. This is a bunch of speculation. Those Winklevoss guys are idiots putting all their money in that, like those kinds of things. And as I learned more about it, I kind of went along with your ethos as well at that point of like, this is going to change everything. Everything's got to go on chain. And this was like 17 and 18. So we had ICO days and Bitcoin was moving up to 20,000 for the first time, and ETH was killing it. And like everything was going to be on chain within a year, right? Security tokens were going to be there. And now what I've realized is that the technology is just kind of an evolution, right? This is not, the purpose isn't to bank everyone in the world. That's just not going to happen. The purpose is not completely get out of the hands of government, or completely away from banks. And so like I've kind of evolved that way. I prefer more crypto kind of DeFi native ethos. So I've been against the ETFs. I'm against a lot of the traditional financialization of crypto. I'm against the government being that involved. Like I don't think having a strategic Bitcoin reserve is that good an idea, because I don't want the government that involved. I don't want the US government or other governments to be able to manipulate the price or to have a say or to make it be a political hot potato or anything like that. I don't want that. So my views are more of, okay, the technology is useful. It's useful because we always move forward. It's useful because being on chain means, again, more transparency. It means more people can participate in different ecosystems. And that doesn't necessarily mean, someone in, name developing country that's got like $50 to their name can now get on chain and become a multimillionaire. What it means is you and I are going to have the opportunity to participate in more capital than we would have in the past. We can participate in things like insurance pools and lending pools and everything else that we weren't able to in the past. So I see it more as a technology to facilitate all that. And eventually it's just going to be finance. Like that's just going to be the financial system. But it's going to come with more opportunities. It's going to come with again, more ability to participate in more diversified capital pools and to diversify my assets, and for everybody's portfolio to be more personalized. And that's what the technology is going to give us. And I'm not as much into the, speculation on the value of a token anymore. I'm actually much more against that, right? Like, a lot of new tokens that launch, I kind of look at them and go, really, should that really be worth that much? Like, should that protocol really be worth billions? They haven't done anything yet. So I'm a little more skeptical of actually most things that get launched in crypto. But I see where the technology is going to be so important. I want to be on the forefront of managing that technology, managing what the technology gives people, and is going to give financial advisors, and is going to give just the wealth management industry.
What are your thoughts on macro? Because we've had whenever Trump's in office, the macro is always exciting. So what do you think is going to happen with tariffs and with the regulatory changes and just with just going forward in 2025?
Who knows? I guess that's the fun part of the Trump administration, is you just never know what tomorrow's going to bring, right? There could be new tariffs, there could be new tariff agreements. And I think that uncertainty actually lends itself to crypto a lot more, right? Because the uncertainty is what makes the markets go crazy. It's what creates volatility, and it gives more opportunities. The macro overall, I looked at it a lot. Obviously anyone who's been into Bitcoin, especially, looks at the macro quite a bit, right? And I think a lot of the Bitcoiners are the ones that they're saying, look, there's going to be inflation. You can't keep doing this, because they went down the rabbit hole and understood it. Overall, man, I've gotten to the point where I try to stay away from it, because one, it's so frustrating. It's so frustrating to try to figure out what's going to go on and guessing what's going to happen. And trying to plan for that, trying to go, well, I think, there's going to be tariffs and therefore this is what it's going to do to the macroeconomy. Because for the last 15 years, 20 years, whatever, people have been trying to do that and trying to go, well, if there's this war over here, here's what it's going to do to oil and gas and prices are going to go up. And they've always been wrong. For the most part, they've been incorrect. And it's because because there are so many interconnected parties. I will say overall that what's come out of this is the realization, I think, from a lot of regions and countries of the world that they don't necessarily need the US, right? They can interact with each other just fine without the US and without the dollar. And I think that's a big part to take from understanding crypto and seeing what's going on in the macro world. You have the BRICS nations, of course, that basically say, look, we can do all this without the US. We don't need you necessarily. We don't necessarily need dollars. Overall, we can, it doesn't even have to be Bitcoin. We can transact in whatever we want and we can do so directly peer to peer. Right. So I think about macro kind of that way, but overall, what's going to happen regarding tariffs, I'm not a big fan of them. I'm not a big fan of what's happened over the last few weeks. I don't think it makes sense. I think it's very protectionist, which is completely not capitalist. And I think you should embrace the fact that the world can transact financially and the world can transact through manufacturing. Like that's what we've done with the global supply chain. Unfortunately, it does put some risks in some places, but the global supply chain makes it to where you and I can afford all the stuff we can afford. You can't be protectionist about it. So it doesn't make sense to me, but it doesn't mean I don't really have a say all that much. I get to vote for president once every 4 years and for Congress once every couple years. And that's about as much as I can do. And the rest of it is preparation. I mean, I used to get all upset about it. I used to get frustrated or worried or whatever. Like, here's what's going to happen to macros, or what's going to happen to housing prices. We got to sell our house and all these other things. And my wife would be like, I drive her crazy. And finally, she just said the smartest thing. She goes, whatever, just prepare for it. Just prepare for all these things. You know how to do it. You're a financial advisor. Just prepare us for it. And then whatever happens, we're good. And so that's coming full circle to what we're talking about with Enclave. We're just preparing people for what might happen, but we're not putting all our eggs in. We think that, the dollar is going to be incredibly devalued or anything. We're going, it might not. What are we going to do about it? How are we going to have liquidity? What are we going to do when that happens? If the dollar value goes down, what are you going to do about it? Are you going to own Swiss francs? Are you going to own Bitcoin? And so the biggest thing we can do, Andrew, is just prepare for it, right? Prepare for what we think, or not even what we think. We prepare for what might happen, prepare for all those circumstances, do so in a way, hopefully with our clients, where they can remain as, on-chain as possible based on the technology and the regulation. And give them lots of outs, give them liquidity. That's the beauty of crypto overall, is the immense amount of liquidity that's available 24/7, 365 means our clients can be a little bit more nimble with what they're doing, because it can be Sunday at 2 a.m. and we can get them out of a position.
Amazing. All right, Adam, it is time for the closing questions.
Okay, let's go.
All right. What makes you pessimistic about the future of crypto, and what makes you optimistic about the future of crypto?
Pessimistic about the future of crypto is definitely the amount of money being poured into new protocols, and those protocols potentially issuing tokens and without building any value there. It's like they weren't able to take the time and build up, you can call it product market fit or whatever. But I think we're still in this time when people are launching tokens and I don't know if the value has moved over there yet. And there's a tremendous amount of money being poured in. And you wonder, when you start getting venture capitalists and you start getting investors like that, they want their out. They want to be able to get their liquidity from it. And they don't have the patience of VCs in the past that would wait for an IPO or a big acquisition or something. They want to get it out now, and you can do that by issuing a token. And I think that kind of waters down a lot of what's being built. So I think that kind of makes me pessimistic, but within all that, there's some optimism, because there's some really cool stuff being created, I think. And so the what makes me optimistic part of the question is, I think that the likes of the big players, as much as I don't like being kind of governed by what BlackRock and Fidelity are doing, the fact that they're coming in and tokenizing assets, tokenizing funds, kind of pushing that down on everyone, That kind of makes me optimistic. Again, coming back from consensus, talking to some of the big players around the world that understand that they're moving on chain and are trying to do so in the right way. And the number of large family offices, the number of large allocators that are not just looking to hold Bitcoin, but looking to actually go on chain and actually looking to see how can we generate yield and how can we move our money around the world and how can we start transacting in stable coins. I think that is what really makes me optimistic. It's the stablecoin issuances. It's the more businesses transacting in stablecoins, because that's what's going to trickle down to everyone else just getting their salary on chain.
All right. So you've been in crypto for quite some time. What is the biggest thing that you've changed your mind about after being in crypto for so many years?
Ooh, that's a really good question. The biggest thing I've changed my mind about, you know what? Honestly, I think there were times when I didn't. I was very high on crypto, and then there were times where I honestly said, I don't think Bitcoin has value. Like I don't see it. People don't really use it for a whole lot. They just store it. And I kind of went down this, almost like an ETH maxi or smart contract maxi thought. And now I'm back to, no, they're separate animals, right? Bitcoin is its own thing, and it has value, and there's a reason for it existing, and it's extremely important. Not only as value and as an asset, but it's extremely important to teach us more about what money is and what it should be, right? It's giving us all new theories and concepts of money. And then, yes, there's everything else, but I'm seeing where they can coexist. They can have their own value separately, and you can have Bitcoin, and you can have ETH, and you can be on chain, and they can all work fine together. And it doesn't necessarily mean that like all the crypto assets are moving in lockstep with each other, but I have gone up and down in terms of Bitcoin, stable coins, back to Bitcoin, and now this idea of, okay, there's a reason for both, but they don't necessarily move together. Does that make sense? Does that help?
Totally. Yeah, no, that's great. All right. Before starting your entrepreneurial journey, you could go back in time and give yourself one piece of advice. What would that piece of advice be?
That's another really good question that I was totally not prepared for. If I could go back, so my entrepreneurial journey, just so you know, started in 2001. So it's been a long time. I forget what it was like to ever work for someone. But if I could go back early on, I would say, I would give myself the advice to say, if you really believe in something, then you need to put a lot more effort than you think into building it, because not everyone is going to see it, and not everyone is just going to jump on board and be like, yeah, here's millions of dollars for you to manage, or here's millions of dollars for your company or something. The idea, I mean, this, right? The overnight millionaires take years and years and years to build that. So I would say having more conviction in my own ideas long enough to get through the really rough parts, I think would be the advice I give myself. And if you have that conviction, then there's going to be positive. The other thing I would tell myself is it might not be the first idea. It might not be the first thing. You're not going to be like a unicorn on your first try. That everything is a stepping stone, I think, to get to where you eventually want to be, or you eventually should be. And I kind of look back and go, everything has kind of been this stepping stone. Like we talked already, this Interaxis was teaching financial advisors. And then over this time, I started to realize, very recently, there's a lot of wealth here and not a whole lot of other RIAs doing this. So we might as well, because who better, like who's going to push the envelope more than we are? So, but it's been stair step. And here I am, 50 years old and finally going, okay, I think Enclave is the thing. And in a few years, technology will change. There'll be more players, and maybe I'll have to go, all right, there's someone's going to buy us and we're going to move to the next thing.
Awesome. Adam, thank you so much. This has been incredible. Where can people find more about yourself and learn more about Enclave and Interaxis?
Interaxis is at interaxis.io. They can go to the website. Enclave is enclavegroup.io. I'm on Twitter at Interaxis8. The number 8 is my handle. Interaxis8 is my Twitter handle. And then you can go find out more about us there.
Amazing.
And if anyone, is interested in more information about, if you're crypto wealthy, if you know people that are, or whatever, and you want more information about it, hit me up on Twitter and DMs, and then we'll start talking through the official compliance processes after that.
Stellar. Thank you, Adam. Appreciate it.
All right. Thanks so much, Andrew. This is great to catch up, man. I know we've known each other for several years, and so it was really, really great to.
About time.
It's about time that we've done this, right?
Awesome. Thanks, Adam.
All right. Thanks.